the needle. So what people try to do in these situations is do it on $1 billion and then lever it up 5 or 10x. The problem with that is that you're posting all kinds of collateral as margin to these banks to give you that leverage. Because then all of a sudden, capturing 150 basis points on 10 billion or 15 billion, now we're talking about real money. And so when these things go wrong and they happen very suddenly, what it does is it puts pressure on all other asset classes because people are scrambling to make sure that they don't get margined out. And what you saw over the weekend was it mostly a lot of that happening, which was a lot of these folks were putting this trade on to the tune of tens or probably even 100 billion plus dollars,
Wow.
of which they had maybe 5 or 10 billion of equity and 80 to 90 billion dollars of just margin. And that's what caused this very quick cycle.
Mm.
Then it looked like it unraveled itself. And so people thought, oh, we're probably mostly past this. I actually think we're not. I've said this before. I think one of the most interesting things I've learned in the last few years about the stock market is the stock market is owned by and large by these algos, right? Meaning there's these large, kind of murky, grayish hedge funds that have these computer trading algorithms that are allowed to be levered to the tune of, 13, 15, 20 times about $50 billion. So these folks are swinging around $1 trillion each. Okay. And we all just live in their world because when these algorithms make a decision and they react to these kinds of events, that's when the real volatility starts. So I think the most important thing was summarized by friends of ours from Goldman Sachs. I just want to, Nick, if you want to just throw up the picture that they sent me. So they sent some really good market insights whenever these things kind of happen to a bunch of their clients. And one of the interesting things that they observed is a couple of facts. The first is the algorithms in the middle of all of this chaos sold about $41 billion of global equities. Okay, no big deal. Except that it actually causes everybody else to have to react, and then they sell billions and billions more. The other thing that they noticed, though, is that we're in a moment in time where you can see how these algorithms will behave over the next month. And right now, if there's relatively minimal volatility and not much changes, the algorithms will have to sell another 160 odd billion dollars of equity. And that'll pull through many hundred billions more from everybody else. So I think we're in a little bit of a delicate moment where the preponderance of the market action will be to continue to sell. And I think it's just going to be, when we look back in hindsight, another reason why getting levered on these things is very dangerous. There's no free money, basically.